Silver didn't just spike, it lost control. On January 26, 2026, silver exploded vertically, ripping from the low 100s to roughly $117.84 an ounce in a single session, a move of about $13 to $15 intraday, the biggest one-day gain since March 1985. Then, within hours, nearly $10 disappeared. Here's the contradiction. That looks like strength, but it behaved like stress. Overnight, price sat calmly between 108 and 111. Then volume detonated, price went vertical, and the selling was just as violent. If you're watching this market or holding anything tied to it, this matters to you. Moves like this don't create stability, they expose pressure. On a 4-hour chart, silver's RSI surged to around 87, a level historically associated with extreme overbought conditions. When momentum stretches that far, the market isn't confirming value, it's testing limits. Now here's the part nobody is saying out loud. This wasn't a normal rally failing, this was a system blinking. And once a market shows you that, the next move is never random. What happened next matters more than the spike itself. After touching the highs near 117, silver didn't collapse into freefall. It snapped back into the 108 range, right where it had been trading calmly before the explosion. That detail matters because it tells you this wasn't chaos from nowhere. It was a release of pressure that had been building quietly. Here's the framing most people miss. This wasn't just a volatile day, it was the collision of two forces that rarely meet at this speed. On one side, aggressive momentum buying that treats price as a signal. On the other, profit-taking and resistance triggered by historical levels that markets remember, even when traders pretend they don't. The move followed 9 consecutive months of gains. That's not a random streak. That's a statistical outlier. Markets don't move like that without consequences. The question isn't whether silver went up too fast. The real question is why so much pressure was already trapped in the system before that day even started. Now watch how the story shifts. If this was just speculation overheating, the damage would already be done. But if this was pressure release inside a much larger pattern, then the reversal isn't the end. It's the setup. Here's the claim that changes how this move should be read. The reversal didn't come from weakness. It came from exhaustion colliding with structure. As silver surged toward the 117 to 120 zone, it ran directly into a long-standing historical barrier that has capped major advances before. The move wasn't gradual, it was vertical. That matters because vertical moves erase support. There are no steps underneath them, only air. When price stalls in that environment, selling doesn't need a catalyst. Gravity does the work. The session produced what technicians watch closely at major turning points, a wide-range candle with aggressive selling near the highs. To confirm a classic topping signal, price would have needed to close deep in the lower portion of that range, roughly below the mid-107s. That didn't fully happen, and that's the key tension. The market showed exhaustion, but it did not deliver confirmation. Now notice what's missing. There was no slow rollover, no steady bleed, no multi-day distribution. Instead, there was speed on the way up and speed on the way down. That's not how long-term tops usually behave. That's how leveraged positioning gets stress-tested. This is where the story flips. If this were the end of a cycle, sellers would have taken control and kept it. They didn't. Price snapped back into a known zone and held, which raises a more uncomfortable question. If that wasn't capitulation, then what kind of pressure is still sitting underneath this market, waiting for the next trigger? What followed wasn't relief. It was escalation. The ascent into the highs was described as vertical for a reason. Traditional trend lines couldn't keep up. Price moved so fast that normal support structures were erased before they could form. That forces markets into a dangerous state where every reaction is exaggerated because there's nothing underneath to slow it down. To make sense of that, traders had to step back and look at the long view. On logarithmic charts, a trend line drawn from the 1970s highs through the 2011 peak intersects almost exactly where silver stalled, in the 117 to 120 range. That's not coincidence. That's memory. Markets remember where excess last resolved. Now here's where normalization creeps in. 9 straight months of gains had already conditioned participants to expect continuation. Pullbacks stopped feeling like warnings and started feeling like opportunities. That's how extremes quietly become acceptable. Compare this to other moments in market history when assets went vertical. The pattern is always the same. Acceleration replaces analysis, speed replaces structure. And once that happens, even healthy corrections feel violent because the system has forgotten how to move slowly. This is where the pressure builds. Not because price went up, but because everyone starts believing it can't slow down. And when that belief sets in, the next move tends to surprise the most people possible. Here's where the evidence gets harder to ignore. The most violent moves during this episode didn't come from people exchanging physical silver. They came from paper markets, futures, leveraged ETFs, and short-term derivatives designed to amplify price. As silver ripped higher, those instruments magnified gains, and when price stalled, they magnified losses just as fast. Margin requirements were raised during this volatility, a move aimed at forcing out undercapitalized leverage. That's not a routine adjustment. That's an intervention. It increases the cost of holding positions overnight and turns aggressive longs into forced sellers almost instantly. Now look at the contradiction. Publicly, the rally was framed as speculative excess. Privately, the mechanics tell a different story. Short positions remained large even as price surged, meaning some traders were betting heavily against the move and absorbing growing losses. That creates a feedback loop where shorts become future buyers while leveraged longs become future sellers. This is the line that changes how you see the entire event. The same structure that drove price higher is the structure that caused the crash. Not sentiment, not panic, structure. Notice what wasn't happening. Physical holders weren't dumping metal. There was no flood of supply. What unwound was leverage. And when leverage unwinds without breaking the underlying price floor, it doesn't resolve a trend. It reloads it. Now the story stacks into a mini crisis because the market wasn't reacting to one thing, it was reacting to several pressures hitting at once. Silver surged into the 117 to 120 zone, then snapped back toward 108, showing both explosive demand and rapid profit-taking in the same session. The overbought reading on the 4-hour chart hit the high 80s, signaling stretched momentum that typically triggers a reset. At the same time, margin changes increased pressure on leveraged positions, accelerating liquidations and forcing decisions that wouldn't happen in a calmer market. And that's only the surface. Underneath it, the pricing model itself was colliding with a bigger monetary backdrop. US M2 money supply was cited around 22.3 trillion, while global M2 was cited around 98.6 trillion. When that much liquidity searches for safety, small markets don't rise smoothly. They gap, they spike, they whip. Now watch how fast this escalates. One day of vertical price action doesn't just create headlines, it creates positioning. It creates fear of missing out. It creates fear of being trapped. And those two fears feed each other, which leads to one unavoidable question. Now pull the camera away from charts and look at where this lands on you. When silver moves $10 in hours, that volatility doesn't stay inside trading screens. It bleeds into premiums, availability, and access. Physical buyers don't experience a smooth price. They experience delays, widening spreads, and sellers pulling inventory while prices reset. If you're not trading leverage, this still affects you. A move like this reshapes behavior. Dealers hesitate to quote. Buyers rush to lock prices. Sellers step back and wait. The number on the screen stops being a price and starts being a signal. That's when markets stop feeling liquid and start feeling scarce. Now here's the part that hits closer to home. When volatility accelerates, everyday decisions change. Do you buy now or wait? Do you trust the dip? Do you assume the system will stabilize? Those aren't ideological questions. They're practical ones. And the faster price moves, the more those choices feel forced instead of voluntary. That's how stress propagates from institutions to individuals without anyone announcing it. If this feels familiar, say so in the comments. Because what's happening here isn't unique to silver. It's what happens when small, real markets absorb pressure from much larger, unstable systems. And that's the part most people realize only after the move is already over. To understand why this keeps happening, you have to stop looking at silver as a trade and start looking at it as a pressure valve. In the global financial system, precious metals sit at the narrow base of what's often described as an inverted pyramid. At the top are massive layers of debt, derivatives, and promises. At the bottom are small, tangible assets that can't be expanded to match the volume above them. Silver is one of the smallest pieces in that base. Annual global production is roughly 1 billion ounces, putting the total market value near just over $100 billion at recent prices. That's microscopic compared to tens of trillions in fiat currency and hundreds of trillions in paper claims. Here's the unsettling insight. When confidence weakens at the top of the pyramid, money doesn't flow down smoothly. It rushes. And when it hits a narrow channel, price doesn't adjust politely. It explodes. This isn't about enthusiasm, it's about incentives. Central banks manage stability by expanding liquidity. Markets respond by seeking assets that can't be expanded. The mismatch creates spectacle, sudden rallies, violent reversals, and normalization of extremes. This is why these moves feel chaotic, but aren't random. They're the system trying and failing to redistribute risk. And once that process starts, it doesn't stop because one market calms down. It shifts to the next pressure point. Now look at where this trajectory bends next, because from here there are only two plausible paths. After the reversal, silver remained well above the prior breakout zone near 100. That level mattered before the spike, and it matters even more now. Markets rarely forget former ceilings once they're tested from above. One path is stabilization. Price consolidates, volatility cools, and silver grinds sideways while excess leverage gets cleared quietly. In that scenario, the system absorbs the shock without drama, and the move to 117 becomes a reference point, not a failure. Momentum pauses, but the structure stays intact. The other path is acceleration. If pressure above the market doesn't release, if debt, liquidity, or geopolitical stress intensifies, then consolidation becomes fuel. The market doesn't retrace deeply, it coils, and when it moves again, it does so from a higher base with fewer sellers left. What decides between those paths isn't silver itself, it's what happens everywhere else. Debt markets, currency confidence, political stability, the things silver reacts to, not controls. This is why certainty disappears here. Both outcomes are viable, both are unstable, and both depend on forces already in motion. The next move won't be announced. It will arrive. Here's the insight that ties all of this together. Silver didn't rally because people suddenly wanted silver. It rallied because the system around it is under strain. The spike, the reversal, the violence of the move, those weren't anomalies. They were signals. Even after one of the sharpest intraday reversals in decades, silver held far above levels that were considered extreme not long ago. That alone tells you the baseline has shifted. The deeper lesson is this. When markets stop moving smoothly, it's rarely about the asset on the screen. It's about the structure underneath failing to absorb pressure without distortion. Small, real markets reveal that first because they have no buffer. This story isn't finished. The forces that pushed silver vertical didn't resolve in a single day. They exposed themselves, and exposure is what changes behavior for institutions, for traders, for ordinary people watching price screens and wondering what still holds. If you want to understand what comes next, not just in silver, but across markets where stress is quietly building, stay with this channel. Because the next move won't start where everyone is looking. It will start where the system is weakest.